Mining gold is currently the biggest game in town, and London and Toronto listed Caledonia Mining has been producing gold at its Blanket mine in Zimbabwe shortly after its acquisition from Kinross Gold back in 2006. Caledonia now has plans to nearly double production in the next 5 years. Mark Learmonth is CFO. He joins us now. Mark, welcome. Before we get on to some of the information behind the balance sheet and the profit and loss and so forth, let's talk first of all about the gold market, because as I said at the top, this is the biggest game in town at the moment. What are your thoughts on where the sector's going?
Well, as we were saying earlier on, I mean, certainly in my lifetime, I've never seen such a high degree of political instability. In Europe, North America, the Middle East, the Far East. And as you got the political instability, many of the world's biggest economies are still struggling, never really recovered. Countries are still printing money, which they can't afford. And don't forget, we operated in Zimbabwe. We know exactly what happens if countries continue to print money which they can't afford. And all of that actually militates to a rising gold price. I'm surprised it took so long for the gold price to recover. Because this thing's been playing out for quite a long time, but it has recovered. We welcome it. We don't, as a low-cost producer, we don't need to see gold prices of $1,300, $1,400, $1,400 an ounce. Clearly, we welcome it because it means we make more money. But yeah, I see gold as having recovered and pretty much staying where it is and perhaps improving. Well,
let's take a look at the share price, because this represents pretty much what's happening with the price of gold in the market at the moment. This is Caledonia Mining share price on a daily chart. Bearing in mind as well, this week we had the announcement that you increased your dividend. What's the dividend strategy at the moment? Because I think you started paying dividend about 4 or 5 years ago, didn't you?
Yeah, so initially we just paid annual dividends. We paid a couple of annual dividends because we found ourselves with substantial cash, and so we gave some back to shareholders. And then recognizing that we're a Zimbabwean gold producer, and the biggest difficulty we face with investors is their concerns about Zimbabwe. And so we somewhat cynically, but we deliberately moved to a quarterly dividend policy, just so every 12 weeks we're sending dividend checks to people and reminding them that we're still there, we're still in business, we've not been nationalised, we're making money, here's a dividend check. So we've been doing that for about 3 years now. Initially it was a Canadian dollar denominated dividend because at that point we're a Canadian company. Then we adopted US dollar reporting, so then we had to move for the Canadian dollar account, a Canadian dollar denominated dividend to a US dollar denominated dividend. Over that period the Canadian dollar had tanked, so there was a bit of, in dollar terms, the dividend was kind of moving around, because in US dollar terms, because the Canadian dollar was weakening. So what we did earlier on this year is we fixed our quarterly dividend in US dollars, so it's 1 1/8 cents per quarter in US dollars, and then earlier on this week we increased that to 1 3/8 cents per quarter. So that takes it from an annualized rate of 4.5 cents to 5.5 cents, and that's reflected in the very significant share price appreciation this week.
Yeah, 42,800 ounces you pulled out of the ground last year of gold, and I know you've got its target of, I think, 80,000 by 2021.
In 2021, yeah.
How are you going to get there? Is it an easy ride? I mean, have you laid the groundwork already?
Yes, we have. I mean, I wouldn't for a minute try to belittle the activities of my technical colleagues. I mean, we're digging a shaft from surface to just below a kilometre below surface, and it's by no means an easy feat to do. Having said that, within the context of mining endeavour, it is towards the low risk end of the spectrum. We're working in an environment that we know very well. We've got all the infrastructure that we need there, so it's not a new project in a new jurisdiction where we've got to put all the logistics and infrastructure in place. We've got significant expertise in sinking shafts. We've already sunk one shaft on an exploration project. We've deepened another shaft which started production late in March. So we've got our own workers have done this before. The rock is highly competent. So once you get down to where we are now,
that's a geological term for.
It's old. It doesn't fall in.
Right,
you don't need to support it.
Right.
So we don't need to concrete line this thing, which keeps the cost down. So that's going as planned. And what's going to drive the increased production from now to 2021 is accessing more material from the deeper levels. It's below 750 metres, which also has the advantage of being slightly higher grade. And so that also boosts, reduces costs and boosts cash generation.
Well, I was going to ask about costs in this. The deeper you go, obviously the more costs you're incurring in getting down
No,
there.
not necessarily. No, not necessarily. It doesn't get much. Well, you might think it gets more expensive as you get deeper, but don't forget, we don't need to cool this mining operation because the rocks we mine are so old. Some of the oldest rocks in the world, they're cooled off. So the deep levels of the mine considerably cooler than the underground was this morning. So we don't need to cool the mine. Whereas the South African mine is very hot. You need to spend a fortune refrigerating them because it's so competent. Doesn't fall in. Yeah. We don't need to spend money on mine supports. So actually, as we go deeper, the costs don't increase significantly. But more importantly, the infrastructure we're putting in place with this new shaft will fundamentally change the way this mine operates, make it much more efficient. So actually, by the time we're operating completely below 750 metres, I would expect our cost per tonne of rock moved to be significantly lower than it is now.
So what are you paying per ounce to get the gold out of the ground? What's the margin profit in it?
The group marginal cost at the moment for every extra ounce of gold we produce is less than $160 an ounce. So every extra ounce of gold we produce costs us $160 and we sell it for $13.50. So we don't need too many more of those ounces to have a significant effect on the overall performance of the business.
Okay, so let's get this right. Cash cost in 2015 was $701 an ounce.
Yeah.
All in was 1,100.
About 1,100. Yeah.
And
so last year was a poor year. You see.
Right. And have you got any idea at all the sort of projections?
Yeah,
for these
they are coming down now on a month-by-month basis as we increase production monthly. These costs are coming down very, very smartly. So we're looking this year at an all-in sustaining cost of, I'd have thought, well below $900 an ounce.
Right.
The average for the year. Clearly in the first quarter it'll be higher than that. By the last quarter it should be a lot lower than that. And the on-mine cost should be down at well into the 500s. So we're a low-cost producer.
And of course, the moment you're sailing into a higher gold price, I've got to talk about how you're going to pay for all this extra work you're doing and so forth. Presumably it's a fair no-brainer.
Well, last year, 2015, was the tight year because the production was relatively low. 42,000 ounces. At that level of production, yeah, the mine generates cash, but because it doesn't generate as much as it will do when the mine's even producing at 50,000 ounces, we were spending a lot of capex last year. We spent $18 million on capex. So last year was quite tight, and the gold price was lower than we'd expected. And so that's why early this year, in sort of early February, we put in place a 6-month cap and collar hedge to lock in and protect us from a lower gold price, but give us full participation above the cap. Because at that point we thought we needed to get insurance if the gold price fell. Where we are now, that hedging arrangement expires, I think today actually, it expires early in July. And then from now on we're completely unhedged, we're producing at a higher level, our costs are lower, and therefore we can self-insure now. Yeah. With a lower gold price. And actually, I think from an overall group perspective, our break-even gold price is now well below $800 an ounce. And so, I mean, if the gold price fell below $800 an ounce, I think we'd probably be one of the few gold mines that can still continue.
Still making money, yeah. Okay, so let's just outline the headlines and we should watch out for. 50,000 ounces by the end of this year.
You should watch out. Sorry to interrupt you. You should watch out. Every quarter, we should be announcing now, quarter on quarter, increases in production, quarter on quarter increases in cash, and quarter on quarter reductions in our average cost of production. That will play out on a quarterly basis. Okay, all right, look, Mark, it's a pleasure. Thanks indeed for joining us, updating us on the Blanket mine there in Zimbabwe for Caledonia Mining. That's the Chief Financial Officer, Mark Learmonth.